This is the Daily Market Rundown live from the Tradelo trading floor. It's February the 3rd and some highlights from today's show. Tariff wars begin, rotation into value ends pretty fast, and the Russel Index is now a bearish target. Good day traders, welcome, happy February, happy Monday. Well, it's not so happy for the markets, of course. We've come into the week again, like last week, blood red across the board. We'll discuss this in great detail today. We'll have a couple of looks at some of the key markets to pay attention to. But let's talk a little bit about some of the overnight moves. It's across the board. I mean, if we're looking at Asia, we've got the Topix down 2.5, we've got the Kospi down 2.5. If we move across to Europe, DAX is down 1.7, and don't forget, European stock markets have really been the key star outperformers so far this year. But of course, like every other stock market, there are a risk market. So we have the DAX down 1.7%, the CAC down 1.6%, FTSE down 1.2%. So they have not, of course, been spared. And then if we move to the S&P, the Nasdaq, they are going to all open within the range of about 1.5% down to around 2.5%. So there's quite a lot of nervousness, risk off at the start of the week. If we then turn our attention to some of course, the currencies, it's very much been long dollar across the board. If we look at, of course, at some of the cryptocurrencies, they have absolutely been hammered with Ethereum dropping over 35% overnight. So a lot of sort of blood across the board. What does that mean going forward? Well, we have to wait and see, of course. I think one of the key things to pay attention to today, one of the key clues, or at least two of the clues, is going to come via the bond markets, number one, and of course, the VIX, number two. But we'll get into that in a moment. Let's start off and talk about some of the key overnight news. Now, it's very much about the tariffs. This is what has led to some of these significant overnight moves. It's, of course, Canada and Mexico have come out and said, well, look, if you're going to slap us with 25% tariffs, we're going to slap you back. Now, the problem, of course, for Mexico and Canada is that if you look at the case of Canada, for example, pretty much 40% of their GDP is derived via exports to the United States. So they are very heavily dependent on the United States for importing their product. And it's no different for, of course, for Mexico. Their GDP is very much derived from the United States. So fine, they can slap on retaliatory tariffs. In reality, it's not going to have a significant impact because obviously the Canadian and Mexican economies are going to be very much hardly hit by the impact from not being able to export, or at least not being able to compete by exporting their products to the United States. Now, just a word on tariffs. I posted a tweet on this over the weekend. Are tariffs inflationary? It depends. It's not a straightforward answer. The thinking goes, and this is how you need to sort of think about it. You almost have to think of tariffs as some form of a subsidy. Okay, so America as a country effectively now is saying, well, look, American companies, if you can build these products at home, I will guarantee you that they will be 25% cheaper than any country around the world, or at least than if you imported it from Canada. Okay, and that's what it is. They're effectively giving local industry a 25% subsidy on producing those products all made in America. Okay, now that's the basic thinking. Now, does that necessarily mean it's going to be inflationary or not? It depends. Okay, it depends on how much demand is there for the product at the higher prices. What industries, of course, will higher prices create demand destruction or not? How are they necessities? It all really depends industry by industry. However, the net thinking, the general thinking is that should these tariffs be imposed, of course, there's quite a lot of dependency on Americans for Canadian and Mexican products. And so should these tariffs remain in place for a degree of time, for some degree of time, they will prove to be inflationary, one-off inflationary, of course, so long as we don't get more escalatory type tariffs. Okay. Now, one of the key takeaways was Donald Trump did say, look, Canada, Mexico, if you strike back, if you're going to sort of apply tit for tat type tariffs, we'll just escalate again. And I think that's where the fear comes into this, is that we've now seen both Mexico and Canada say we will strike back. And as a result, I think the market's starting to think now, well, does Trump then turn around and say, well, 50% on Canada and 70% on Mexico? And it turns into an all-out sort of, mine is bigger than yours type scenario. So that's the key thinking here. Now, The important thing to take away is it doesn't really matter what your opinion is, whether you think it's inflation or not. I think what matters is, where is this going to escalate to? Where is the end point for this? Now, typically speaking, if you traded much of Trump in 2016, what you'll notice is that Trump very much sort of will always take the hardline stance. He'll always escalate before we de-escalate. In other words, things will probably get worse before they get a lot better. Now, very, very important to stress, Trump will be talking to the leaders of Canada and Mexico later on today, and that's important because it does mean that those tariffs may actually not go into play tomorrow at all. Right? So there is that possibility, and that's why today's not the type of day you want to be taking any kind of aggressive positioning. You want to sit there, fingers on the mouse, waiting for that news flow, and of course, come tomorrow and Wednesday, we will then definitively know whether or not those tariffs have been imposed or not. Now, one thing I also want to mention is if you look back at the 2018 tariffs, 2019 with China, Trump did follow a very similar playbook where he said, look, we're going to do significant tariffs, and if you retaliate, we will retaliate in kind again, and it kind of became this tit for tat. In reality, very little was put on in terms of tariffs on China, and it was just because China agreed, they signed on the dotted line to buy more of United States products. So again, if we just lean on that 2016 example, this is probably how it's going to play out. This is ultimately the playbook Trump is adopting from 2018. So from this call, it's very possible that maybe we get an extension today. Maybe Trump agrees for a 1-week extension because they're going to talk. That's perhaps an outcome, and the markets will take that very positively. Okay, the fact that there's dialogue means there's going to be some sort of a deal done where we will, for most parts, sidestep the worst part of the tariffs. Okay, now in terms of Europe, Europe of course got hit pretty hard because I don't know actually why everyone sort of is quite shocked and surprised that he hasn't pointed a finger at Europe and said, well, you next in line. In reality, maybe it was some of the words used where he used specific rhetoric to say, well, look, Europe, you're definitely getting some tariffs. I'm just dealing with these Canadians and Mexicans first, and then I'm coming your way. So Euro is down quite aggressively today, but again, it's not new. These tariffs are not new, and we do, of course, have the EU meeting today where they will determine some form of retaliatory type tariffs. The point is, and this is key, if we do get retaliatory type tariffs, it's very different to 2016, 2018, Trump's first presidency, in that there was no real retaliation from China, okay? Not to the same degree as we have now. If, in actual fact, we do go ahead with these 25% tariffs, and they are there for a period of a couple of weeks and months, and Canada and Mexico do retaliate, and we have the same thing in Europe, this is going to be significantly problematic for global growth. Okay, particularly over the course of the next 3 to 6 months, we will see some form of a growth slowdown and demand destruction. Okay, and the market's not priced for that. Remember, the markets this year, we're talking about the wonderful soft landing, the re-acceleration and growth in the United States. Now, a few things to take away overnight. First one, of course, Russell was down the most. Okay, Russell was down 4% versus the S&P down, 2%. Now that's important because last week, if you were following the show, you'll remember I said to you that we saw some rotation out of tech into value. That seems to have been what held the market up last week. Everyone was getting very excited, moving back and rotating back into value, and the Russell was a real outperformer last week. Ding, 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 ding. Tech worries are still there. AI is still a problem. DeepSeek hasn't gone away, and neither has Alibaba. The point is, if you can't rotate this week into value because now value is coming under threat because we have a potential growth scare on our hands, well, then where are you going to rotate to? And that's why I think this week is significant for equities. It's also why I think we get quite a hard sell over the course of this week. There's just simply nowhere else to rotate. If you can't rotate into equities, into tech, because of AI, and you can't rotate into value, and you don't want to rotate into the bonds simply because you fear that these tariffs will be inflationary, where do you rotate to? Cash. Okay, and that's key for this week. That's what I think you need to watch out for. I think we could see an everything sell-off type week where we have higher yields, we of course have a stronger dollar, and everything sells off, including, and I mentioned this on Friday, gold. Okay, don't be surprised to see gold have that sort of liquidation move. It's done it 4 times over the last year where it has that very aggressive sell-off, flushes out with all the other markets, and then gets bought up as that safe haven type play. Okay, definitely something to watch out for. If we do get a 3-4% correction over the course of this week in the gold because of that very hard offer, don't be afraid to fade that one because it's paid very good dividends over the course of the last year. Now, Goldman Sachs has put out a note. They're leaning on this idea that tariffs will prove to add about 0.7% to PCE should the tariffs remain in place. Now, just to put that into perspective, the Fed is battling with sticky inflation right now. Okay, the Fed desperately wants to see inflation and have confidence that inflation is going to keep moving to target. Now, if PCE suddenly is going to be roiled over by tariffs coming in, well, guess what? The Fed ain't cutting again this year. In fact, the Fed's going to be drawn into having to hike again this year. And again, not a thesis Wall Street has thought about. Wall Street has not been planning for hikes this year. Wall Street's talking about double-digit returns because of a soft landing scenario. Okay, keep all of this in mind. Again, it's very fluid, the situation. It is a case of by the end of today, we could be back at where we closed on Friday because Trump has agreed to give another week of leniency towards Canada and Mexico. So it's a fluid situation. But if these tariffs go in play, all bets are off this week. The equity market bull run is going to be very aggressively challenged. Don't forget, S&P still up 50% in the last 14 months. 5-0 S&P. Don't be surprised to see a little 10-20% correction over the course of the next couple of weeks should these tariffs remain. Now, moving into the open, again, just to remind you, the problems did not go away from AI last week. In fact, we can see Nvidia is pretty much on the chart in the overnight market. It was actually opening somewhere around there, around 113. That was the worst case scenario. And you can see it would have taken out, it would have flushed out a couple of those longs that bought in that September period. The point is that Nvidia is looking weak again. It looks like it's going to open right on last week's lows. What happens there? Well, like I said last week, not a market you want to be buying, not a market you want to entertain right now. It's very much needs to stage a correction. No one's really sure what that valuation should be. The gap held all of last week. It got tested once, twice. Nvidia was the massive underperformer last week. And guess what? These sorts of formations don't typically end like this in this sort of consolidatory period. They typically end where we have some sort of a very aggressive hard flush, and then we start to get those dip buyers re-emerging. Okay, the point is Nvidia should be trading back down towards that $100 mark, perhaps even lower. Where it goes, anybody's guess. I'm not a fundamental analyst. I don't know what the fair value of Nvidia is. I don't really care. What I care about is we're below 115 this week. If we hold that gap below 115 this afternoon, don't be surprised to see us continue moving lower. Okay, and of course that's gonna bring that theme of just general negative sentiment in the tech space. Like I said to you, in terms of the value space, you don't want to be owning value right now when there's a fear of higher inflation, lower growth. You don't want to own value stocks. So don't want to own tech, don't want to own value. What do you want to own? Well, I don't want to own the equity market. So watch out for that. Now, just a summary of last week. Always good to look at this. Last week, Nvidia was down 16%. Okay, biggest company in the world. Second biggest company was down 6.5%. Okay, so two biggest companies in the world were down quite significantly last week. Again, the problems around tech are not gone. It's been sort of almost disguised because everyone rotated last week. The problem is they all rotated into value, and now they're going to have to rotate somewhere else. So it's going to be a fun week to watch. Quite a lot of fireworks I expect over the course of the week. Now, just before we move on, a note on our sponsor, Tradelo Trading. Tradelo provides futures traders with an all-in-one trading application. The tools within the application include, of course, automated risk management, trade journals, data analytics, premium education, verified leaderboards, and a very collaborative trading community. More details, click the description in the channel and go and subscribe for a free version of the application. Now, if we go and have a look at one of our key charts, one of our key themes, and one of the key markets I'm going to be very focused on trading today, it's all about the Russel Index. Why Russel? Well, it represents those small caps in the economy, those ones that are extremely dependent on a low rate environment, a high growth environment. Okay, in other words, now we're going to have a growth scare at a time when the Fed, of course, has only just begun the cutting process. They've only done 100 basis points of cuts. So at 4.5% rates and perhaps a growth scare incoming, Russell technically and fundamentally is a fantastic market to trade. Now, What you will note, of course, is look how much stronger the Russell was over the course of last week relative to NASDAQ, relative to the S&P. And that was that value play, that moving back into value. The problem is we are set to gap a little bit down today. Keep a very close eye if that gap holds and we do start to hold in below this 2270 level. Don't be surprised to see the Russell over the course of this week move in and towards that 2160. Now, why do I like the Russell? Well, what I want to showcase to you is if you look at this little bar here on the December the 16th, that was the Fed meeting. Okay, so that was when the Fed came out more hawkish than expected, and you can see we never actually even reclaimed that high. In other words, the market never managed to scrape back that high, despite the fact that S&P and NASDAQ were both hovering around or close to those record highs at the start of this year. Okay, the point is Russell's been a massive underperformer ever since that Fed meeting. And now, given I think we've got a growth scare incoming, we have something very similar to July last year. What happened in July? It was the very, very poor non-farm payrolls print where the SAM rule was triggered and everyone went, oh, recession incoming. What did we do? Well, we did 13.5% in 3 days. Okay, keep a very close eye. I suspect we got something similar. Notice we had quite a lot of two-way trade in there before it happened. Something similar. Quite a lot of buyers in there last week consolidating. I suspect we gap and we move our way very quickly down towards 2160. And then once below 2100, very much the Russell is in trouble. Why? Well, if you look at since that October rally, remember everything rallied since October 23. Okay, that was the sort of low tick for NASDAQ, S&P, and Russell. But what you'll notice in particular the Russell is higher low, higher low, higher low, higher low, higher low, higher low. In other words, there's been this sort of drift trend higher. Of course, it's been an underperformer. But should we break below this 2160 or 2200, should we close below there this week? Guess what? The formation is complete, and now the Russell should move very quickly down in towards that 2000 mark over the course of the coming weeks. Keep a very close eye. Technically, Russell is a very, very good sell. It's a very hard sell, and I do expect to see that lead to the downside over the course of this week. Because why? Well, like I said, high rate environment. If bond yields do push higher this week, it's going to be even more problematic for Russell, and that's where my attention will be. Now, the last thing to pay attention to today is talk a little bit about US yields. Why? Well, like I said to you, we're not quite sure yet if this is going to prove to be inflationary yet. We can see from the charts that it looks like, if you look across the bond markets, they're all doing a little bit of a flattener today. And what that suggests is a combination of risk off or perhaps even a little bit of a growth concern, not yet a panic, a concern. And what I want to just point your attention to is it's very good to think of these tariffs quite similar to COVID. Okay, what happened in COVID? Of course, we had the supply shock. The result was there was a lot of supply and no demand. The result when we had significant inflation as a result of that, and we have this new sort of high price for products. Okay. Now, the point is we didn't have any demand destruction. Why? Well, because everyone was given money in their bank accounts. Okay, in the developed world, everyone was subsidized to some degree by the government. In other words, those higher, more costly products were technically not more costly because the government subsidized that higher cost for you. Okay, the point is this time round, if we are going to impose tariffs and we are going to have a world where products are 25% more expensive, the reality is we're not going to get that subsidy from governments. Okay, governments are not going to pay for you to afford those more expensive products. And so in this instance, we should get quite a bit of demand destruction. That's basic economic theory, of course. That could prove to be wrong. Everyone could still have massive amounts of savings or spend on their credit cards. The point is this time is a little bit different to COVID 2020 in that I suspect it will create a little bit of a growth scare because of that demand destruction, because no one's being subsidized. Okay. Now, what we should see over the course of this week from the bonds is a bit of tug and pull. I suspect you may get the bonds, in particular the back end, rallying a little bit on a growth scare, but you may also get yields rising. Now, if yields do rise, it is going to be pointing towards a more inflationary type environment. And like we know, when we do see higher rates, they are going to create a little bit more unwanted tightening in financial markets. And guess what? That's going to just be one more problem for the stock market. So keep a close eye on those bonds. If we do see that 10-year yield back up above 460, back above 465, all bets are off. You will find the S&P quite aggressively down on the week, as well as the Nasdaq, and of course the most sensitive to all of that, the Russell Index. All right, that's then our key topics for today's session. Now, just a few words in terms of risk management. Don't forget, of course, markets are very illiquid right now. There's a lot of uncertainty, whether it's AI, whether it's now a bit of a growth scare, whether it's he's going to put the tariffs in, he's not going to put it in. There's not much liquidity go around. Okay, that's why we're seeing some of the moves we're seeing. So make sure you are managing that risk accordingly. And then finally, do go and comment in the description box. Tell me, what are your views on Trump? Do you think it'll be inflationary? Do you think it'll be recessionary? What are your views? Post them in the comments. And of course, don't forget to like and subscribe the channel. That's it then for today. Good luck out there. Manage that risk. Go make some money.